Hello, everyone. My name is Ralf Korn. I will give the first talk, and for this, I will share my screen. So my talk has a slightly strange title, and I will explain whatever is in the title during this talk. And this is based on a joint work with my former PhD student, Anne-Sophie Kra, and Zoran Nikolic, a colleague from a German consulting company, formerly with Generali. So the task I'm looking at is to calculate the so-called solvency capital requirement, which is, roughly speaking, the amount of money that an investor or an insurer needs, such that it can cover the liabilities that the insurer has by the end of the year with a probability of 99.5%. And this is even by law, it's dictated, so where practical insurance and reinsurance undertakings shall derive the solvency capital requirement directly from the probability distribution forecast generated by the internal model of those undertakings using the value at risk measure outlined in Article 101. So in this Article 101, it says 1 in 200 events, so 99.5%. But on top of that, you should have the full probability distribution. And this, of course, makes this a tremendous task. So how could you do that? Of course, you can make an unrealistic, oversimplistic assumption on probability distributions, like the loss function is normally distributed. But the regulators will not accept that. So internal models have to be checked by the regulators. So simple assumptions on the probability distributions are not okay. On the other extreme, what you can do is a detailed Monte Carlo simulation of the internal model to derive a sufficiently accurate empirical distribution function. However, this requires simulations inside the simulation, and we will see that this is computationally infeasible. There is an approach called the replication approach, which is very interesting, but I will not talk about that. What I will present to you is the so-called least squares Monte Carlo approach. I will not start right away with my application. I will start with a simpler application. I want to show you how to derive the distribution of an option price. Now, for those who don't know what an option is, it's a contract that guarantees you a non-negative future payment at some time capital T, which is given by a functional form depending on the underlying stock or on the underlying index or whatever at another time. And for this price, we mainly have to calculate a conditional expectation at time t conditioned on the state of the world, so the stock price t. Now, how can we do that? If we would have a formula for that, just put the xt in the formula and evaluate it, but we assume that there is no closed form representation. And on top of that, we assume that x of t is high dimensional, like dimension 10 or 20 or something like that. So here's an idea. The nested Monte Carlo approach. What should we do? We start at time 0 with a stock price normalized to 1, and then we simulate a huge number of evolutions of the stock price until time t 0.5, say 100,000, 10,000. You say, why not 100? Because the xt is high dimensional. And then in each of those states here, what are we doing? We're evaluating the conditional expectation by simulating a lot of paths here, evaluating the option price at the end, discounting that back, and get the conditional expectation, and we approximate that by the average, the mean over those final payments that we get. What we then do is we use the GI, those means, and we use those values to approximate the distribution by the empirical distributions of the GI. So this is theoretically correct. The only drawback is, as said, it will be computationally infeasible. You know, think about, you generate 10,000 past states of the world here, then you do another 10,000 in all of those, And you might say that's still possible. No, the problem we will later see is computational intensive on that part here. And I can even give you numbers that it takes weeks to calculate that. As an alternative, I'm presenting the so-called least squares Monte Carlo method. So that consists again of simulate a large number of paths, sometimes only the numbers of those prices at time small t and at time final t. Then I'm evaluating again the payment of the option, this function h, x of t, for the x of capital T just simulated, and I'm relating those two with a regression function. Yeah, so I've got x of small t, and I've got that h of x of t, and I got a lot of those pairs, so I can do a regression, a linear one, or something else. And I derive a regression representation Rx of t for Gx of t on the basis of what I simulated. If I have that, then I can simulate a huge number of representative values here. X of t, put them into the regression function, and then approximate the distribution of Gx of t by the empirical distribution of Rx of t. So in my picture here, that's how it works. Simulate something that leads you here and simulate one path that leads you there. So what you now see is where we approximated the conditional expectation here by an average in the nested Monte Carlo method, I'm approximating the mean by just one value. On top of that, I'm using the regression between those values here and the values there, and I hope to correct for that. Now, is it good? In a very simple setting for a European call option that delivers me that payment at time 2, it's not so bad at all. Look here, the orange one, this one here, is the exact price. For this, we have a formula, a closed formula in that simple example. The red dots and the somewhat brown dashes here, they are the quadratic and the cubic regression function. This is just a linear regression function here. So if we look at that, this area covers 90% of the probability distribution of x of t. So there it's extremely accurate, I would say. And even if I go to 99%, it's accurate here, it's accurate there. And only here we have a slight deviation, and that's typical because the other two are polynomials, and what we're approximating is no polynomial. So if it goes far out, the polynomials, they will deviate from the exact value, but still it's okay. So here are some tasks and problems that I have to come up with. Of course, we're mathematicians, I should say something about convergence results. But there are also practical implementations here that I have to consider. So which kind of regression function should I use? Linear regression, some kind of neural network or whatever. So the number of simulation runs for calibrating the regression function, it's clear, as many as possible. Yeah, but the limitation here is the computational time, and we will see that. So the question how to choose the x values, so how to cover the space of the underlying randomness, and how to obtain the results from that. And what is particularly interesting in our example is we had to get the ground truths from. Remember, we should calculate the 99.5% quantile of the loss function of the insurance company. Did someone ever realize that there was a 99.5% loss? So it's really a question here, if we want to judge the performance of our model, that we need the ground truths. The validation needs an innovative approach. So here's the first thing. Here's the theoretical justification. For people from deep learning, one can say this is like a universal approximation theorem. So what we want to approximate is this expectation of y conditional of x. And one knows by the factorization theorem that this is a functional of x, and let this be an L2. Then we consider a set of k linearly independent basis functions of L2, where the first one is just a constant one. So we consider the projection of that functional to the first k basis functions. It's given like that. But the beta k are, of course, hard to get. So for that, what we're doing is a least squares estimator of the beta k, and we got this approximation, which is, of course, based on the number n of simulations that we have. And then we get the following two convergences. Of course, if I'm letting k go to infinity, and if the family of basis functions is complete, then the projections, they converge in L2 towards the real functional. If I'm fixing k, however, which I have to do, and if I let n go to infinity, then f hat k over n, so the empirical approximation, that converges to fk of x almost surely, which is the usual Monte Carlo convergence. So you see, you got a convergence in k should be large, but also n should be large, which is a classical balance problem. So back to our application, the application that we want to look at. So what are the necessary ingredients for calculating the loss distribution in an insurer's context? Now, the first thing looks a bit strange. We need a so-called cash flow projection method or tool for generating market consistent future scenarios. What is this? Now, an insurance company invests money. An insurance company has customers. Customers sometimes go away, sometimes they are dying, sometimes they switch from customers paying in to customers receiving a pension. So all this has to be modeled, and it has to be modeled on a contract by contract basis. There are a lot of risk factors that, of course, also influence that, like the interest rate, like the mortality evolution and other things. So this cash flow projection tool is an internal software that is computationally extremely expensive. In this software, in this insurance company that we worked with, one such run costed 55 seconds in the CPU. Then we need specification and simulation of the underlying risk factors that I talked about. So we need models for the evolution of the interest rate, equity prices, and others. And I will come back to that also. We need, of course, a simulation concept. Should we simulate everything uniformly distributed? Should we transform? Should we do it deterministically? Another decision we have to make. And we have to make a decision on the actual method, how to determine the loss distribution. We're mainly interested in this 99.5 confidence interval, but by law, we should also forecast the whole probability distribution. So that's another question we have to deal with. So here are the necessary key steps that we actually have to overcome. So we need a detailed description of the simulation setting and the required task before we start. We need a concept for calibration and for validation. And then after that, we actually have to apply the LSMC method to forecast the full loss distribution. The first step, at least the first part here, this is given by this cash flow projection method, the cash flow projection tool. The SCR requirement is defined by law. And the risk factors, these are specified in the internal model the insurer has. Now let me introduce a little bit of insurer wording. If I'm simulating those risk factors and don't care about P or Q, that's specific in finance, I can explain, but it's not necessary for this talk to understand here. A simulating of the risk factor, this is called an outer scenario. So this is how the world outside of the insurance company behaves. If I'm then calling the CFP method, this is called an inner scenario. This is the inner evolution inside the insurance company. So here are the tasks in a more mathematical way. Calculate the full loss distribution at the end of the year. From this, derive the solvency capital requirement as that amount of money that allows you with 99.5% to have assets that have a value high enough to cover all the liabilities. And then the simulation setting, the risk factors are given. And at each realization, at each outer scenario, we have to calculate this conditional expectation of the future payments, the future net profits of the insurance company, meaning on contract by contract. And the capital T is how long we're projecting into the future. And as we're a life insurer, 40 to 60 years into the future is the normal distance that we're going into the future. Okay, let's get back to this. This is a list of the variables we're looking at. So you see we've got 17 variables, and of those 17 variables, the first 9 are capital market risks. They are about the interest rates, the volatility, so how does the interest rate, how intense does it move, change of the equity volatility, the credit spreads, so how risky are the credits that we look at, shocks certain on that. And the others are actuarial risks like mortality, how long are the people living, how intense is the intensity of dying at the moment, what is the longevity trend, or are people just simply going away by taking a lapse, so by ending their insurance. So a lot of variables. Okay, what to do? We generate the outer scenarios by just plainly simulating all those risk factors. We just simulate them. Think about a random simulation, or think about a deterministic quasi-random one with a Sobol sequence. We use a large number of outer scenarios to cover the space evenly, and then for the inner scenarios, we typically use 1 or 2 run per scenario from the outer world. So as in the LSMC method, we just have only an average over 1 or over 2 values here. Why that? Because this costs so much. Yeah, this costs so much. But now, as a result, we have pairs, xk and yk, for setting up a regression function. That's good. Now we're in a standard mathematical task. So how to choose it? Here's my first suggestion. Do linear regression where the basis functions are monomials of this type. Yeah. So at step K, we choose this monomial to be included in the basis. And then, of course, we find the least squares optimal coefficients, beta hat n, by solving a conventional least squares problem. So that's pretty much a simple least squares problem. However, where's the problem here? Now, my dimension here, my dimension d is big. You had it, d was 17. So we cannot expect that our k is small here. We've got 17 variables. So if we want to have a good approximation, the k is enormously big. And in one of the examples we computed, we had a k of 224. So coming up and saying we start with the full model and then we decrease it, or we start with a simple model and then we increase it, this is also computationally infeasible. And for that, we use the principle of marginalization, which says start with the constant function and then have a set of candidates that can be included in the basis. And for those, we require that all their partial derivatives are already being chosen as basis function. Among the candidates, we choose the one that leads to the biggest reduction of the AIC criterion, if there is one, or if we reach the upper limit of the number max of basis functions. So here's an example, x1 squared, x2 can only be among the candidates if x1 squared, x1, x2, x1, and x2 are already chosen. Yeah, and Here is the first 15 iterations that we produced. So after 10 iterations, we have chosen those. So you see the first thing that we're choosing was xk, then we were choosing x6, and then at step 8, so it's k equals 7, so it's step 8, we have the first mixed term, we have x4 times x8, then we have x4 squared, and so on. There are other things here that I'm not explaining, so the AIC goes down, we consider the mean squared error on the validation sets, but that's it. So that is one opportunity. Here's the second one. Choose a feed-forward neural network, and that's standard notation here. Just for completeness, I've given that. Okay, I don't have to tell you that we have to do hyperparameter optimization, so that was from a previous talk. But it's clear that we have not a big data problem. We have a problem of a lot of variables, so still there is a lot to do to come up with a good neural net. I told you there is the problem of validation. Yeah, so we have to think about that. How can we actually check if the proxy function is good? So where do we get the correct values from? Now we invert our method now. Think before we generated a lot of outer scenarios, and what we do now is we generate only very few outer scenarios, but now for each outer scenario, a lot of inner scenarios, meaning the conditional expectation in those xi's is estimated quite accurately. So this then gives us the ground truths. For each xi, we try to get as close to the conditional expectation. Of course, this costs a lot of time, therefore we can only have only some xi, and they should be carefully chosen. Then we check the performance of the proxy function, we do tests, and if they are passed, that's good. If not, the proxy function has to be improved. Okay, here we are. If the proxy function is there, we can just set everything inside the proxy function. That can be done in real time, even if it's 131,000 simulations, because we evaluate the function. We don't need the CFP tool. That does not take a lot of time. We have an example where we did it. We have the linear regression result, and first we had a proxy function with 60, later with 224 monomials. Validation was good. Not excellent, good, but it took less than 6 hours. And the nested simulation would have needed at least 25 weeks, which is unacceptable. So linear regression was done. Then the question was how to come up with neural networks. And using neural network in a brute force way was quite frustrating. We trained 300 feed-forward networks, and here are some ways how we tried to do a kind of random search on a Sobol grid. And of course, if we combine all this, there are more than 300. After 300, we simply stopped. And it was quite frustrating. Yeah, because there was not a single neural network that was beating the linear regression clearly. So we finally came up and took the 10 best ones, which are here, and built an ensemble of them. And then this ensemble actually convincingly was beating the ordinary least squares polynomial validation set. So I have here some validation measures, and you see the ensemble always has a smaller value in absolute terms, so it's clearly better. Of course, this does not necessarily be the end of the line. Yeah? There are more things that could be done to optimize the neural network. Okay. What I'm showing you now are some sensitivity results and maybe a bit about interpretability. Now, what do we have here? We have the first variable, and the first variable x1 is about the changes of the interest rate. So if it stays constant, don't think too much about those values. We have to renormalize them because we used real data from an insurance company, and we were not allowed to give here the real numbers. So in 0, we still have an error here, and it's clear if the interest rate increases, that's good for the insurance company because they need less money to cover their future liabilities. What we see here is the range between minus 3.3 and plus 3.3. That covered 99%, or 90% of the space. And even for 99%, which went from here to here, we have nice agreement between all the neural nets and the polynomial from the ordinary least squares. What we see at the borders here, that there is this polynomial behavior, which is of course bad. This will go down dramatically, and this cannot be justified. So the neural nets here perform more reasonably. If we're looking at the volatility of the equity that changes, and then we actually looked at a value which goes from minus 0.3 to 0.3. And now you see the problem. The polynomial behavior fully comes into the game here, while the neural nets perform on the right side quite well. On the left side, they also deviate from each other. So the ensemble was by far the most stable one. We also tried to look at, so for these plots, we only modified the variable x8, the others were kept constant to 0. For the other, we modified x1, the others were kept constant to 0. Now we do a two-dimensional variation. So the interest rate changes and the equity changes here, shot on the equity market. And this is quite interesting because if nothing happens, we're in the middle. But there is a twist here if we're slightly negative here and here. And while we're here, if the equity market went up a lot, then the interest rate has nearly, well, only a slightly vanishing effect. While if the equity goes down, the interest rate also has a large effect here. So you see a highly nonlinear two-dimensional relation. While if I'm looking at the relation between the housing market and the equity market, well, the equity market, of course, has this behavior, but more or less independent of the interest of the housing market. Okay, finally, some kind of visions, questions, and wishes. As I said, this is quite a brute force application. So getting the best possible network, or even the best possible network architecture, will require quite some work, I would say. However, for this we've got time. For which we don't have time is to simulate more of those inner scenarios. For these we are limited. Same for the validation. Getting an idea on error bounds would be great. Of course, as we already have the linear regression, we could see that we get below the linear regression, but it took us quite some hard work. So it was not just a neural network with one hidden layer or with 10 neurons. So these are quite deep neural networks, and we had to build up an ensemble of them. There is another thing, to be able to include structural relations motivated by financial and actuarial mathematics, like if the interest rate increases, then that's good for the insurance company. We saw that in the one-dimensional setting, but it's not clear how to do this a priori, like in a logistic regression or in a linear regression, just take all the weights positive and then you have it. So this is something that would be interesting to see also in neural networks. Or we could maybe separate parts of the neural networks, like saying we have the financial risks and the actuarial risks separated. That would also be a good thing, how to separate them here. A very reasonable thing would be how to learn that cash flow projection tool. This is much more ambitious. You know? So this tool that projects everything 40 years into the future, if that could be learned by a neural net, that would be fantastic, because that would overcome all the limitations of the computations here. And then I mentioned that at the beginning, we don't have a problem of a huge data set. So we have a kind of small data set here. The computations are quite expensive. That's our problem. So the question here, if we have enough data for deep learning, is from my side also not clarified. So I thank you for your attention. And of course, I'm looking forward for questions and comments. So, is there any kind of question or comment? To give you an idea how important this problem is, insurance companies have to set aside a lot of money here, a lot of money. And it's important if they are quite accurate on one hand, because they don't want to set aside too much money. This is money that cannot be invested. On the other hand, for customer protection reasons, they should not set aside too few money, because the customer has to be protected, not the company. So it's quite important to be quite accurate, here. On the other hand, they have to publish their reserves. So if they can say our solvency capital number is 240%, which means we've got at least close to twice and a half as much as we need. This, of course, looks nice because they are pretty safe. On the other hand, it looks bad because it means they are putting too much money aside at the moment. So if they have a solvency capital ratio of 400%, that is something that shows that they are inactive and not doing something with their money. As this is easily available from time to time, it is a very critical number. Yeah, so if you can improve this, if you can come up with better methods to calculate the solvency capital requirement, that would really be a great achievement. So let me give you a little bit of time for thinking about a question. By the way, if there are questions to the talks also from people who later look at the recorded version, all of the speakers today are happy to answer those questions. Simply send a mail. And if you don't have the mails of the others, simply send a mail to me. You can use the Slack for that if you like, and that's it. Okay, it doesn't seem to be a question here. So let's make a 10 minutes break until Robert's talk, and then we continue.